Every market, every movement, and every chart is a reflection of human behavior. Prices rise not because the world changes, but because emotions do. Fear, greed, impatience, and hope. They drive the crowd to act without thought. The masses rush to buy when the story feels safe, and they sell when the fear becomes unbearable. But the few who rise above emotion see what others miss. They don't trade the market, they trade human behavior. They wait quietly while the crowd screams. They buy when others are fearful and sell when others are proud. They understand that the real battle isn't on the chart. It's inside the mind. The smart operator knows that control is power. When others react, he remains calm. When others chase, he plans. When others panic, he observes. This discipline is what separates those who survive from those who disappear. In life, just as in markets, the crowd will always be emotional. People will follow the noise. But if you can stand apart, if you can silence the noise inside yourself, you gain the advantage that no algorithm or system can replicate: clarity. Control the crowd by controlling your mind. Because once your emotions are mastered, every decision, in trading or in life, becomes intelligent, patient, and unstoppable. The market is not made of numbers, it is made of people. Every candlestick, every bar, every tick represents the collective heartbeat of thousands of minds reacting to uncertainty. It is not logic that drives the majority of movement, it is emotion. Fear and greed are the two invisible hands that pull the strings of every decision, every hesitation, every loss, and every triumph. Fear shows itself in hesitation, the trembling hand that refuses to buy after a fall, the panic that sells at the lowest point. It makes traders believe safety lies in following the crowd, even when the crowd is running toward the cliff. Greed, on the other hand, whispers promises of endless profit. It fuels the rush to buy at the top, the belief that this time will be different, that the price can only go higher. Together, these emotions create the rhythm of the market, surges of optimism followed by waves of despair. What many never realize is that markets are designed to exploit emotion. They rise to lure in confidence, then fall to punish it. They test conviction, patience, and discipline. The professional understands this pattern not as chaos, but as the natural law of human behavior. Price moves where emotion is strongest, and where emotion is strongest, opportunity hides in plain sight. When the majority feels comfortable, risk is greatest. When fear dominates, value is born. The masses see opportunity only when it is obvious. The professional sees it before anyone else dares. This is not prediction, it is perception. The ability to read emotion through price and volume, to sense when the crowd is exhausted, and to act before emotion turns into movement. The crowd wants to be right immediately. They demand reward without patience, results without process. But the market does not reward urgency, it rewards discipline. The calm observer watches emotions swell and fade just as a tide comes and goes. Every panic is followed by exhaustion, every rally by complacency. Those who understand this cycle stop reacting and start anticipating. The mirror of the market shows not what others are doing, but what they are feeling. Every surge of volume is a heartbeat of excitement or fear. Every long wick or failed breakout is a sign of emotion clashing with reason. To study the market, one must study humanity. The charts are not random. They are psychological maps, recording the behavior of millions who cannot control themselves. The one who reads emotion correctly gains an edge that data alone cannot give. Technical analysis tools and systems are only translations of behavior. Beneath them lies the real language of the market, the ebb and flow of emotion. To understand it is to see beyond numbers, to sense the truth behind every move, to recognize that every great rise and fall begins not on a chart, but in the collective mind of those who participate. In every market movement, there are two kinds of participants, those who react and those who observe. The first group, the crowd, moves with noise, emotion, and urgency. They are driven by what they see on the surface: a sudden rise, a breaking headline, a flash of green or red on a chart. They are pulled like magnets by the energy of the moment, their decisions rooted in impulse rather than understanding. They chase what feels right instead of what is right. The observer, however, stands apart. The observer is patient, deliberate, and calm in the face of chaos. The crowd's greatest weakness is its need for confirmation. It waits for validation before acting, for the signal everyone else can see. But by the time the signal becomes clear, the opportunity has already passed. Markets move because the majority reacts too late. Every breakout that excites the crowd was already built during the quiet phases of uncertainty, when the professional was watching silently, accumulating or preparing while others were distracted. Observation, not reaction, is where real timing is born. Observation requires control, not of the market, but of the self. It demands the ability to sit still when others rush, to wait while others panic. The observer studies the relationship between price and volume, the rhythm of emotion, the behavior of participants who cannot see beyond the moment. To observe means to detach, to recognize that behind every candle there is human behavior expressing itself in real time. The professional does not guess what will happen. He studies what is happening and lets evidence guide judgment. Reaction is the product of emotion, observation is the product of discipline. The crowd reacts to news, rumors, and sudden moves because they cannot bear uncertainty. They equate activity with control, but in truth, constant activity only exposes weakness. The professional understands that waiting is an action. Watching the market unfold without interference is not passivity, it is preparation. The moment to act arrives only after enough has been observed to justify conviction. The difference between the crowd and the observer lies not in knowledge, but in perception. Both may have access to the same data, the same charts, the same information. Yet one is blinded by excitement while the other sees through it. The crowd believes it is trading against the market. The professional knows it is trading against the crowd's emotion. Every impulsive reaction from the masses leaves traces. Footprints that reveal where liquidity lies, where stops are clustered, where fear is strongest. The observer studies these traces patiently, mapping out the intentions of those who cannot control theirs. Observation is a skill of silence. It thrives in stillness, in moments when the market is uncertain, when others are loudest. The observer listens not to opinions but to behavior. He sees that every spike, every retracement, every hesitation tells a story about confidence and doubt. The crowd moves first, the observer moves correctly, in the fast pulse of the market, where prices flicker and emotions shift by the second. Patience becomes the most undervalued virtue. Yet, it is the foundation upon which every enduring success is built. Patience is not the absence of action, it is the presence of control. It is the invisible force that separates the impulsive from the prepared, the crowd from the professional, and the temporary winner from the lasting achiever. Most people enter the market searching for quick results, instant confirmation that their choice was right. They crave movement because stillness feels like uncertainty. They equate waiting with weakness, and they mistake speed for intelligence. But markets are structured to exploit impatience. The moment a trader rushes for entry or exit, the market takes advantage of that urgency. The professional understands that waiting is not wasted time, it is strategic preparation. Every phase of stillness in the market carries information: who is accumulating, who is distributing, who is uncertain. The patient mind recognizes these quiet signals long before they become obvious to others. Patience is strength because it resists the need for validation. The crowd wants to see proof before believing. They wait for headlines, indicators, or confirmation from others before acting. But by the time proof appears, the opportunity has already shifted. The patient individual moves at the beginning of a change, not because they predict it, but because they have spent enough time observing to recognize subtle shifts that others overlook. They have trained themselves to trust process over impulse. Patience also requires emotional resilience. The market constantly tests conviction through uncertainty. It rises just enough to tempt greed, then falls just enough to provoke fear. It shakes out those who cannot hold steady. Impatience magnifies these swings, turning every fluctuation into a personal test of confidence. The impatient trader feels every tick as a verdict, every retracement as an insult. The patient trader, in contrast, views fluctuation as natural rhythm. They understand that price does not move in straight lines and progress rarely does. True patience is active. It studies, prepares, and waits with intention. It watches structure form, volume shift, sentiment turn. It is alert, not idle, a stillness filled with awareness. When opportunity finally arrives, patience allows immediate, decisive action because there is no hesitation born of doubt. Every step has already been visualized, every scenario accounted for. The act of waiting refines judgment and strengthens execution. In trading, the impatient often confuse movement with progress. They chase setups that look appealing but lack foundation. They jump from one idea to another, mistaking activity for productivity. The patient individual does the opposite. They build conviction slowly. They gather evidence, align context, and allow the market to reveal its hand. This is why patience is not merely a tactic, it is a mindset. It requires accepting that success unfolds on its own timeline, not on the one we impose. Patience also transforms perception. It sharpens intuition, helping one to see the underlying story rather than isolated movements. When one waits long enough, patterns emerge, not just in charts but in behavior. The same cycle of optimism, greed, fear, and regret repeats endlessly. The impatient experience these emotions, the patient observe them. Each repetition becomes an opportunity to understand how markets and people truly operate. Impatience often comes from fear, fear of missing out, fear of being wrong, fear of waiting too long. These fears cloud judgment and force decisions. The market senses this fear and uses it as fuel. Every premature entry is the result of wanting certainty before its time. The patient person, however, accepts uncertainty as part of the process. They know that no perfect signal exists, and no amount of waiting guarantees safety. Yet they wait because waiting allows clarity. Patience is the art of alignment, aligning thought with timing and action with opportunity. In trading, as in life, moments of advantage appear briefly, surrounded by long periods of noise and indecision. The impatient get trapped in the noise, the patient learn to listen through it. The patient understand that not every candle needs attention, not every move deserves reaction. They conserve energy for the few moments that truly matter. Patience builds confidence quietly. It removes the constant need to be right. When one learns to wait, ego fades, replaced by perspective. Losses no longer sting as deeply because they are seen as part of a larger structure, not personal failure. Gains no longer inflate pride because they are simply the outcome of discipline. Patience dissolves emotional extremes and replaces them with balance. A steady mind unshaken by either success or setback. Time rewards those who understand it. Every professional knows that opportunity is not created by movement, but by the imbalance between those who wait and those who cannot. The market constantly shifts wealth from the impatient to the patient, from those who demand results now to those who can wait for conditions to mature. This transfer is subtle, yet constant. The same principle governs life beyond trading. Every worthwhile pursuit, mastery, success, understanding, requires enduring long stretches of uncertainty before visible progress appears. Patience does not mean doing nothing. It means doing the right thing at the right time, not everything all the time. It is deliberate restraint in a world that worships haste. It is measured silence in a crowd addicted to noise. It is the invisible line dividing reaction from reason, impulse from insight, failure from mastery. The greatest challenge in the market is not prediction but self-control. The constant movement of price, the noise of opinions, and the pressure to act all feed one's emotions until clarity disappears beneath waves of impulse. The individual who cannot control emotion becomes a servant to it. Fear, greed, and impatience take turns steering decisions, each promising safety or reward but delivering confusion instead. Emotional control, therefore, is not optional. It is the foundation of clear thinking in an environment built to provoke reaction. Every price movement is designed to evoke emotion. A sudden drop tests courage, a sharp rise inflates confidence, and consolidation breeds frustration. These emotional responses are predictable and visible in collective behavior. The crowd sells at the bottom because fear convinces them that safety lies in escape. The same crowd buys at the top because greed convinces them that momentum will never end. Emotion turns perception into distortion, and distortion into loss. The market exploits this vulnerability repeatedly, feeding on the reactions of those who mistake emotion for insight. Clarity begins the moment emotion is recognized, not suppressed. It requires awareness, the ability to observe one's own mental state before it shapes decisions. When emotion goes unchecked, small impulses become major errors. A trader who enters out of boredom or exits out of anxiety is not responding to the market but to the noise within. True clarity emerges only when the internal noise is silenced. In that quiet, the chart stops looking like chaos and begins to reveal structure. Patterns appear not because the market has changed, but because the observer finally sees without distortion. Emotional control transforms perception of risk. Fear exaggerates danger, greed minimizes it. Both distort judgment, pushing one to act either too soon or too late. Controlled emotion, however, allows one to assess risk objectively, not through the lens of hope or dread, but through probability and structure. When emotion no longer dictates reaction, the decision becomes logical, precise, and deliberate. Control does not eliminate emotion, it channels it. The energy of fear becomes alertness, the energy of greed becomes ambition, and the energy of doubt becomes caution guided by reason. Markets constantly test emotional endurance. They move against open positions to measure conviction, to see who can hold steady when pressure rises. The majority interprets these moves personally. Every fluctuation becomes a judgment of their skill or worth. Emotional control removes that personalization. It allows one to treat every outcome as information, not as identity. A loss becomes feedback, not failure. A gain becomes confirmation, not validation. Clarity emerges because emotion no longer blurs interpretation. The disciplined individual knows that clarity is fragile. It must be protected from impulsive behavior. This protection comes from structure, predefined plans, entry and exit rules, position sizing, and routine. Structure acts as armor against emotional storms. When decisions are guided by a plan rather than reaction, emotions lose power. The plan becomes the filter through which all impulses are tested. Without it, emotion leads every move. With it, emotion becomes background noise. Emotional control also means resisting the influence of external noise, opinions, news, and social sentiment that amplify volatility of thought. The crowd trades emotion as much as price. A headline can trigger mass excitement, a rumor can cause panic. The controlled individual understands that information is never neutral. It carries the emotions of those who spread it. Clarity comes from independence of thought, from separating personal perception from the collective hysteria that surrounds every major market move. When emotion dominates, vision narrows. One focuses only on immediate outcomes. The next candle, the next profit, the next confirmation. Emotional control restores wide perspective. It allows patience to return, strategy to mature, and timing to align with opportunity. It replaces reaction with observation. The calm mind can see both sides of the market, strength and weakness, fear and greed, and act with balance. Emotion clouds this vision, reducing complexity into impulse: buy or sell, win or lose, right or wrong. The market rewards clarity because clarity leads to consistency. Emotional control is the discipline that maintains that clarity through every phase, during profit, during loss, during uncertainty. It is not achieved once, it must be practiced constantly, refined through every mistake, reinforced with every test. The longer one remains emotionally steady, the more clearly the patterns of human behavior become visible, and the more naturally rational decisions follow. The market moves in silence before it moves in sight. The greatest changes are born not in moments of excitement but in moments of confusion. When the crowd is certain, the move is already complete. When the crowd hesitates, the foundation for the next direction is quietly forming. Uncertainty is not chaos, it is the birthplace of opportunity. The majority, unable to tolerate stillness or doubt, retreats into noise while the observant few prepare in patience. Every major shift, every large breakout, begins when the collective attention drifts elsewhere, when emotion replaces observation, when most participants are too distracted to recognize what is quietly developing beneath the surface. Distraction is the market's camouflage. It hides intention behind boredom, minor volatility, or conflicting signals. During these times, volume dries up, sentiment divides, and conviction weakens. The crowd grows impatient, abandoning structure for emotion. They demand movement, forgetting that the absence of movement is often the market's most deliberate act. While the majority loses focus, the professional studies accumulation, the slow, deliberate gathering of positions while the world looks away. This is where preparation meets opportunity. The real move does not begin with headlines or momentum, it begins in silence, in the indecision that precedes every turning point. Uncertainty creates vulnerability. The masses seek clarity from external sources, analysts, influencers, or short-term indicators, because they cannot endure ambiguity. Yet the professional thrives in it. Uncertainty is where mispricing occurs, where value hides beneath confusion. The ability to remain steady in those moments grants access to opportunities others dismiss as noise. When the crowd cannot decide, liquidity thins, and the patient can position with minimal resistance. By the time confidence returns, the structure has already been built and the path forward becomes inevitable. The majority's distraction is often emotional rather than logical. A series of small losses or missed moves fractures focus. Traders begin to chase elsewhere, looking for excitement or quick recovery. This dispersion of attention weakens discipline. They exit positions too early, abandon watch lists, and ignore quiet markets that seem inactive. But in that inactivity, the groundwork for future movement is being laid. Levels tested, supply absorbed, and sentiment neutralized. What appears as nothingness is often preparation. The professional understands that the absence of motion is not stagnation but construction. Uncertainty also acts as a cleansing mechanism. It removes weak participants who cannot hold conviction. Each false move, each fake breakout, each slow consolidation shakes out the impatient. The crowd interprets this as randomness, but the observer recognizes it as design. The market must confuse before it can move decisively, because only through confusion can it trap emotion and fuel direction. Every strong trend feeds on the energy of those who were wrong at the turning point. Their exits become the entries of the patient. Distraction comes in many forms: news events, short-term volatility, or emotional exhaustion after a trend. The majority believes that action must always follow attention, that constant engagement ensures success. The truth is the opposite. The market rewards focus, not presence. Those who can maintain observation while others drift away gain insight into the quiet shifts of balance that precede momentum. They notice subtle signs: volume building on down days, price holding steady despite negative sentiment, sudden strength where weakness once dominated. These are not coincidences but signals, invisible to the distracted eye. Every phase of uncertainty is an opportunity to measure conviction. When the majority hesitates, liquidity narrows, revealing where real strength or weakness lies. The market exposes its intention only to those patient enough to watch through doubt. The crowd interprets sideways movement as wasted time, but within that structure lies information. Who is buying, who is selling, who is exhausted. Each pause is a dialogue between fear and confidence, and the observer learns to listen without bias. The professional understands that clarity comes only after confusion, never before. The crowd seeks confirmation before acting, but confirmation marks the end, not the beginning. By the time the move becomes visible, the advantage is gone. Major movements ignite when the last hesitant hands release their grip, when conviction has been drained from the market, when noise has silenced understanding. It is in those moments of distraction and uncertainty that preparation meets opportunity, and movement begins from the shadows of hesitation. The market is not a collection of random numbers, but a living reflection of human behavior. A constant dance between fear, greed, hope, and regret. Those who chase price chase emotion, because price is merely the surface expression of what people feel. Every candle, every spike, every correction is a visible trace of invisible psychology. The crowd sees movement and reacts to it. The master studies the reason behind that movement. Understanding behavior, not predicting price, is what creates consistent success. Price moves because people move. It rises when optimism overwhelms caution and falls when fear overpowers reason. These shifts repeat endlessly because human nature does not change. The same emotions that drove markets a century ago drive them today. The same overconfidence near peaks, the same despair near lows, the same impatience in between. Mastery begins when one stops fighting this truth and starts using it. The student of behavior learns to read emotion in volume, hesitation in candles, conviction in breakouts, and exhaustion in reversals. Each chart becomes a mirror of collective psychology. Chasing price is the behavior of the crowd. It stems from the illusion that more activity means more opportunity. The crowd buys because it sees movement, not value. It sells because it sees decline, not exhaustion. They react to the latest tick, ignoring the emotional buildup that precedes it. In doing so, they become predictable. Their stops, their entries, their panic, all visible to those who understand behavior. The market feeds on this predictability. It moves against emotion, rising when fear peaks, falling when greed dominates. The few who observe behavior instead of price recognize these turning points long before they become obvious. True mastery requires empathy, not sympathy for others' losses, but an ability to think as they think, to feel what they feel without becoming part of them. To understand behavior is to understand anticipation, knowing what the crowd will do next because you understand what they are feeling now. This insight cannot be gained through indicators or patterns alone. It comes from patient observation of how humans respond to uncertainty, pressure, and temptation. The price chart, stripped of context, is meaningless. Its meaning is created by the emotions driving it. Every false breakout, every failed rally, every sudden reversal tells a psychological story, where confidence turned to doubt, where patience turned to panic, where greed turned to fear. Those stories repeat endlessly, offering lessons to those who study them and traps to those who ignore them. Mastery is not about predicting where the market will go next, but about understanding why it goes there. The professional's edge lies in comprehension, not speed, in recognizing that markets move not because of numbers, but because of people. To understand people is to understand movement. To understand movement is to read price without chasing it. In every market, noise dominates the surface. Opinions, forecasts, signals, and predictions fill every space. Most participants act from that noise, trying to keep up with movement, reacting to every shift as if speed equals advantage. Yet beneath that noise operates a different kind of participant, one who rarely speaks, rarely shows intent, and never acts without preparation. The true professional plans long before the crowd even notices that something is forming. This preparation is invisible, and its power lies in silence. Silence is not inaction, it is observation in its purest form. The smart operator watches the market through phases of confusion, gathering information, studying how the crowd behaves at different points of pressure. Every reaction from others becomes data. Who buys on strength, who sells on weakness, who hesitates when price compresses. The professional constructs a narrative from these behaviors, identifying accumulation or distribution, strength or weakness, confidence or fear. The plan forms quietly, piece by piece, long before a single position is taken. The crowd, on the other hand, acts first and thinks later. They trade for the sake of participation, terrified of missing a move. but the market rewards patience, not presence. The professional understands that opportunity reveals itself only to those who wait for alignment, structure, timing, and sentiment all pointing in one direction. Silence becomes part of that process because it eliminates distraction. When the mind is quiet, patterns become visible, and meaning emerges from what looks like randomness to others. Planning requires more than analysis, it demands emotional distance. The smart operator is not seduced by short-term movement or external noise. Each potential trade is examined under multiple scenarios. What if it goes right? What if it goes wrong? What will confirm conviction? What will signal failure? This mental rehearsal builds confidence rooted in logic, not emotion. By the time the action occurs, the decision feels effortless because it was made long before the trigger appeared. Silence also serves as protection. The more one reveals intent, the easier it becomes for the market to move against it. The professional does not advertise plans, opinions, or expectations. Their silence hides accumulation, disguises distribution, and masks motive. While the crowd argues over predictions, the quiet mind acts without announcement. The market rewards those who operate unseen, those who do not need validation from others to confirm their direction. The smart operator understands that preparation defines performance. Every entry, every exit, every adjustment is part of a premeditated structure built from observation and patience. The action itself is only the final moment of a long internal process. The apparent decisiveness others see is simply the execution of a plan already complete in the mind. Silence before action is not hesitation, it is composure. It is the discipline of waiting until every condition aligns, until noise fades into opportunity, until planning and timing converge into a single, deliberate move. The market has one consistent goal: to provoke a reaction. Every sudden rise tempts greed, every unexpected drop ignites fear, and every period of stagnation breeds impatience. It is a psychological arena designed to expose weakness, not through force, but through persuasion. Most participants enter this arena believing they are fighting the market, but in truth, they are fighting themselves. The only true opponent is internal: emotion, impulse, and ego. When one learns to master these forces, external movement loses power, and the market's ability to control behavior disappears. Control begins with awareness. The moment one recognizes that the market is not personal, that it does not reward or punish but merely reflects human behavior, a shift occurs. Fear of loss and excitement over profit become neutral observations rather than emotional triggers. The professional understands that every price fluctuation is just data, not a verdict. Emotional detachment transforms chaos into information. The crowd reacts to each tick as if it carries meaning about their worth. The disciplined trader watches the same tick as part of a broader structure. Self-control is the foundation of consistency. The market thrives on inconsistency. It survives because most participants cannot maintain discipline through uncertainty. They change strategies after every loss, increase risk after every win, and trade for reassurance rather than logic. The one who maintains composure becomes an anomaly. The fewer emotional responses a trader displays, the fewer weaknesses the market can exploit. Control is not about suppressing emotion, but about channeling it into awareness. Fear becomes caution, greed becomes focus, and doubt becomes patience. The disciplined individual knows that control is not achieved once, it must be renewed every day. Each session, each setup, each fluctuation tests it again. The market continuously offers opportunities to abandon control through revenge trading, premature entries, overconfidence, or hesitation. Every test is a mirror reflecting how well one governs the self. The goal is not to eliminate reaction, but to recognize it instantly and prevent it from guiding decisions. This self-regulation transforms uncertainty into advantage because while others are ruled by impulse, the controlled mind remains steady. When emotion drives decision-making, perception narrows. The mind begins to see only confirmation of its fears or desires. A falling market looks like disaster, a rising one feels like safety. But when self-control is strong, perception expands. Price becomes a signal, not a sentence. Trends, reversals, and pauses all become part of a neutral structure that can be studied and acted upon with precision. Control removes the emotional filter that distorts logic and replaces it with clarity rooted in observation. The market cannot manipulate an individual who no longer reacts. Every trap set by volatility, every fake breakout, every emotional wave loses its power against a disciplined mind. When control is internal, nothing external can dictate response. The calm participant becomes invisible to the rhythm of the crowd, unaffected by noise, guided only by structure, patience, and awareness.